Well, it's Michael Douville coming to you from Phoenix, Arizona. Now, Phoenix is enjoying a very, very good position in the U.S. market, and that we're right next door to California. California has a lot of population that's leaving, and they're migrating elsewhere. And a lot of them are coming here to Arizona. Arizona, you can be in from here in Phoenix, you can be in Los Angeles in 5 or 6 hours. So if you're my age and you want to retire, you're coming to Arizona, you can always go see the kids in 5 or 6 hours, or go to the beach or go to Disneyland, whatever you want. And the growth here in Phoenix is pretty phenomenal. We're in a great market. Now, that's not happening all over the country. We're seeing problems in New York. We're seeing problems in Chicago. We're seeing problems in the Silicon Valley and, of course, in San Francisco. A lot of these are high rent districts, high tax states, lots of regulations, and there's just a demographic shift. Here in Arizona, we've talked about the 4 different trends that are going here. One, of course, is the in-migration. We're getting 185 Californians every single day come here to Arizona. That's every single day. I should say Arizona, just here to Phoenix. And we get another 25 to 35 others coming here, a lot of people coming from Chicago and the Midwest. So somewhere around 220, 225 people net every single day. So we have a big in-migration coming in. We still have the baby boomers that are retiring. And of course, baby boomers have influenced just about every market they've ever entered. They're retiring and they're moving south. So they're going to Florida, Texas, and of course, Arizona. And they're retiring here. Not only can you get a nice place, but we have a really good climate and a great, very, very friendly for retirees. Lots of things to do. And we're getting those in droves. We also have a lot of people coming from Texas, if you can believe that, because the oil patch has been in trouble. They've had 2 boom and bust cycles in the last 4 years. And we're in an administration that's fairly energy unfriendly. So a lot of people are transplanting themselves from Texas. And then we have the high tax states coming to the low tax states and the business friendly states. And of course, again, that's Florida, Texas, Arizona. Arizona, very, very business friendly. So we have a timing model. I should say I have a timing model. And the timing model has been fairly accurate. Now, I'm not saying that it can be 100% accurate. I'm not saying that it's infallible. But what I'm saying, it has been a guide. And it's been a fairly good guide for us. And it's based on an 18-year cycle. So let's just take a look at a little stylized version. So this is an 18-year cycle that we're looking at. Of course, when we're looking at the big bubble in 2006 and 7, that's pretty much unmistakable. And if we take 18 years from there, we're looking at a peak here, somewhere like a completion tape to peak in a cycle, somewhere around 2003, 2004. Now, these aren't exact figures. Now, sometimes there have been smaller cycles that are about 16 years in length. There's been some that are 19, but they really run very, very close to 18 to 18 and a half years. They've been very, very true to cycle. That's because people never really seem to change, and the same things happen over and over again. Very similar to the business cycle. Now, this should be around 2023, 2024, could go 2025, where we peak, then we complete. Now, the completion is not going to be so much fun. So we want to take a look at our portfolio and probably start selling sometime in this time frame. Maybe when we start getting 2023, 2024. We'll certainly review. We'll certainly see some tells. We'll know what's going on in the marketplace. But we're right around here. We're in that second completion. We've got that mid-cycle correction that we look at. And that's right through here. We're probably pretty close to this, probably coming down around this cycle. This was a double dip. The timing model did very, very accurately identify March 2018 as the correction, beginning of the correction in the real estate market. We can see that very, very clearly on our charts. That would have been right here. It came down. A lot of the markets across the country really had a growth rate go to 0, somewhat basically negative. The better ones, again, when we're talking about Florida, Texas, and Arizona, some of their high growth states, their growth slowed down, but never really went negative. In Arizona here, we went down to 5.6% growth rate, which was still very, 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 very admirable. We love that. And then we came back up and we're experiencing a little bit of a correction. Now, I don't know how severe the correction is. You're seeing the correction in San Francisco. You're seeing a correction in Chicago. You're seeing a correction in some of the northern states of Minnesota, Wisconsin, and New York. And people are leaving. But again, there's a shift. There's a demographic shift. These are long-term demographic trends that are in place. And here in Arizona, we are not experiencing any slowdown. We actually have a housing shortage from all the people that are coming here. Literally have 225 people net every single day, which means we need about 100 houses every single day built, and we're just not building anywhere near that. So we have a shortage here of housing, and it's driving prices up. Now, we're saying in my timing model, once we get in here, this is the accumulation phase, and that should run us maybe another 12, maybe 14 months. And then we get into the explosive phase where you're going to see very, very significant run-ups in prices. Now, I've had a lot of people asking me, are we doing that now? Because the last 6 or 7 months really have had a very strong trajectory. So I have to say, yes, it's very, very possible. It would be a very, very early into the cycle, but nonetheless, it needs the bearing to watch. Here in Arizona, we have not only a lot of growth, we have shortages. So we have a much higher demand than we have supply, which is driving prices. And I don't see that changing at the moment. Most of our houses, unlike the bubble when in 2005 and 2006, where people were just buying houses and just, they were shuffling them like a deck of cards. No one actually ever used the properties. All these properties are filled. We've had a shortage of not only housing, but rentals, and rentals have gone up significantly too. So it's a little different than what we had in 2006. Those are the scary words when we say it's different this time. We do need to watch that. However, looking into the economy, I really don't see any evidence of a slowdown. I'm actually thinking that the second quarter is probably going to be even stronger than what we're looking at now. And it'll bear watching. But once we get into this, I still think this is probably 12 to 15 months away. And then we're going to start getting into the explosive phase. And that should be 2023, 2024. This could actually even be 2025. Now, all this is predicated upon a government that doesn't do something that's, lock us all down, stop the economy. Then, of course, that'd be a Mad Max event. And it's really going to change events, and that could trigger a shortened cycle. So we all need to pay attention to it. We're dealing with a lot of money and oftentimes on these cases. But let me just go through this so I can give you some clarity of what my thoughts are. You're always welcome to contact me at michael@michaeldouville.com. Whatever, if these are any thoughts that you have, you really should talk to your financial advisor. Certainly discuss this with your significant other, your spouse, to make sure that this is something that you want to get involved in. But at the moment, it's just an incredibly compelling investment. Now, it's not just real estate. So I just want to get over here and let you take a look at this. Is the U.S. Treasury. You can see here in 1980 and 81, when the interest rates peaked, they've been coming down ever since. Now, typically they're on about a 35-year cycle down, 35-year cycle up, about a 70-year cycle. This is actually running a little longer than that because we're looking at about a 40-year cycle. So I think we've probably bottomed in interest rates on yield. But at the moment, we have a bottoming process. So this could continue for a long, long time. And we have a very, very friendly Federal Reserve and central banks across the globe that are suppressing rates. And I think that is going to continue for probably through the cycle. I could foresee another 2 or 3 years where we have very contained rates, in which case it's going to allow us to get much, much higher prices, because that's where I think we go. I think we get much, much higher prices. I also want you to look at this. Now, this is coming from one of my favorite sites, and it's Zero Hedges was courteous enough to give us all these slides. So I do want you to know that the interest rates we have now in the globe are the lowest they've ever been in history. Now, what that tells you and what it tells me is that you should be a borrower, not a lender. So when you see rates that are this low, you should be borrowing money against them. So I would say take a look at your financial portfolio. If you have free and clear properties and you want to get some cash, it would not be a bad idea for you to maybe put 50% encumbrance on it. We never want to jeopardize the asset, of course, but it would be good to take some of the money, because I think that you're not going to see these rates again. As I showed you on a cycle, it's about a 35-year cycle. I think we're in a bottoming process, then it's 35 years up, which means that these rates probably aren't coming along for a very long time. And they are at literally the lowest in the history of civilization. So why not take advantage of this? This is just a great idea. Now, coupled with that, you might go ahead and look. Let's look at this next slide. And this is again coming from Zero Hedge, but this is what I put out the other day. It's Bloomberg's commodity. Now, I am seeing inflation in the pipeline. We have not seen this for a very, very long time. It's certainly in the pipeline. Can we get up to 3 or 4 or 5%? Yes, we can. Here's the target of 3%. Now you have the Federal Reserve is giving us a target of 3%. The commodities are already there. Now, could they go to 3.5, 4.5, 5.5? Yes, they absolutely could. So if you have commodities running at 5%, can you get inflation kicked out at 5%? Pretty easily. Now, this is just at the bottom of the producers index. So if inflation gets pervasive through the system, which it has the appearance that it's going to do, that means that every time someone touches the product, they're going to be raising the price. So this 3 or 4% at the low level of commodity prices could, by the time you get to the finished goods, be up 7, 8, 9%. Could it go to what we had in the 70s, where you have 13%, 14%? Yes, I think that ability is probably in it. What does that mean for you? That means if you have inflation, just inflation at 5 or 6%, and you have it for 3 or 4 years, that means that your purchasing power has been diminished by 15 to 20% in as little as 3 to 4 years. Couple that over 10 years, now you're talking about a very, very severe purchasing power, and it's telling you that inflation is coming. So that tells you that there is a switch from the financial assets to the real assets, and you're going to start seeing that in gold and silver and agricultural products. Certainly food products, you're going to see it in forestry products, all your basic materials. And you're going to see that in housing, because housing is made out of all those basic materials. So when you see copper go up and you see lumber go up, and lumber is up 116% in 2020 alone, and that's including the recessionary time. 116%. Steel's up over 60%. So this inflation is coming. So let's couple that with the fact that we're going to be looking at historically low interest rates. I mean, you can get interest rates really, really cheap. I mean, somewhere in the 2s and in the 3s. This is historical. You can get the non-owner occupied investor money for in the low 3s. This is a wonderful, wonderful opportunity for you to get into something that is a investment that will give you inflationary hedge and is probably going to grow. So that's how I think we get to our higher prices. I think we're coupling not only demand, but inflation. And you just have to think of this. What happens when demand meets inflation? Of course, then you get incredibly higher prices. And I think that's how we do that. Now, there's some great opportunities around the country. They don't necessarily have to be in Florida, Texas, or Arizona. There's lots of growth markets across the country. Florida, Texas, and Arizona, however, will be the prime markets. Here in Phoenix, Arizona, we're probably the #1 market. We have a huge, enormous organic growth coming here. So this might be a good place for you to consider. Talk to your financial advisor, see if this is what you want to do. But you really might want to talk to them about the shift going into some real assets, because this inflation looks like it's very, very real. So I'm here in Phoenix. You can get hold of me at michael@michaeldouville.com. You can get hold of my corporate office at area code 602-942-4200. My very, very best to you. And I wish you the best. Bye-bye now.